It's Thursday, the 4th of February 2021. Welcome to the Fear and Greed Business Headlines, the business news you need in just 5 minutes. I'm Sean Aylmer. Today's headlines: Telstra will sack 1,400 workers as corporate Australia gets back to more normal operations. Plus, Amazon boss Jeff Bezos to step down after 30 years. The Reserve Bank Governor calls for higher benefits for the unemployed, and Westpac loses a critical court battle involving financial advisors. One of Australia's most iconic companies, Telstra, will cut more than 1,400 jobs as part of a $1 billion transformation program, which aims to split off old infrastructure assets. The cuts are not related to COVID-19 and marks the first time a large company in Australia has embarked on a major business-as-usual cost-cutting exercise since the pandemic. Last week, Telstra Chief Executive Andy Penn said it was time to get back to more normal operations, having hit pause on the restructure at the beginning of the outbreak of coronavirus. The job cuts will take to 8,000 the number of workers exited under the program since its beginning back in 2018. By the end of the process, the telco will have around 24,000 people. Telstra has struggled to compete in recent years, weighed down by its expensive fixed-line business, fighting more nimble mobile providers, and battling a new infrastructure giant in the government-owned national broadband network. Telstra has put much store in the rollout of its 5G network, and last week Mr Penn said he hoped to have coverage of 75% of Australians by June this year. While most stocks are trading well above their level of March last year, the bottom of the share market crash, Telstra is broadly unchanged. Over the past year, only oil giant Woodside Petroleum has performed worse than Telstra among the top 20 stocks. Telstra is the most widely held stock in Australia, and many people, especially retirees, rely on regular dividends from the company for income. Let's hope things pick up for their sake. In overseas news, Amazon Chief Executive Jeff Bezos will step down later this year after nearly 30 years in the job. He'll remain as executive chairman. Mr. Bezos created Amazon as an online bookstore and turned it into a behemoth, which during the final quarter of last year sold more than $125 billion worth of products globally. Drug giant Pfizer said it expected to generate $15 billion from sales of its COVID-19 vaccine this year. The jab, developed with partner BioNTech, is forecast to be the company's biggest seller, with 2 billion doses in 2021. And New Zealand's unemployment rate has dropped below 5% for the first time since the pandemic slashed growth. The economy has proven remarkably resilient, thanks in part to action taken by the country's government early during the pandemic. Locally, Reserve Bank Governor Philip Lowe was speaking yesterday, fresh from the Central Bank Board's decision to keep interest rates on hold and expand its bond buying program. Dr. Lowe said he hadn't pledged to keep rates on hold until 2024, but it was his best guess that conditions for a rise wouldn't occur until then. Those conditions are increases in wages. Dr. Lowe backed the federal government's decision to wind back JobKeeper from the end of March, but called for a permanent increase to the level of unemployment benefits as a matter of fairness. He pointed out that while the loss of JobKeeper would hurt the economy, households and businesses had an extra $200 billion in savings built up during the pandemic. Westpac lost its High Court appeal against the decision, which found that bank staff had provided personal advice to customers in breach of financial planning laws and had not acted in the best interests of those customers. In financial planning, that's a serious breach, and Westpac faces heavy fines. It's a win for the corporate regulator, the Australian Securities and Investments Commission, and will impact all financial service firms that work with financial advice, because it better clarifies the distinction between general and personal advice. Building approval surged almost 11% in December, driven higher by private home approvals. The jump was way above expectations and in part reflected the government's home builder program, which has been extended until March. A hotel quarantine worker in Victoria tested positive to COVID-19 overnight, prompting new restrictions from State Premier Daniel Andrews. Private gatherings will be reduced to 15 people, masks will be mandatory inside, and the plan to allow 75% capacity in workplaces has been paused. Thus far, the buy now, pay later sector has been able to avoid too much regulatory scrutiny. successfully arguing that they don't provide credit products. But Britain's financial regulator said it plans to bring providers such as Afterpay and Zip, both Australian companies operating in the UK, into its supervisory regime. Under new laws, the buy now, pay later groups will have to undertake affordability checks before lending to customers. It'll cause plenty of headaches for providers, merchants and customers, and also add to pressure on local authorities to do more to regulate the sector. In response, both Afterpay and Zip's share prices fell more than 1% yesterday. That's the Fear and Greed business headlines for today. Make sure you've hit subscribe so you don't miss out. There's also more in today's full Fear and Greed podcast, including an interview with Connell Hanna from media monitoring company Stream. I'm Sean Aylmer. Enjoy your day.